some interactive polling. Okay, and understand the audience a bit more, okay? So if you haven't signed on yet, do scan the QR code so that you can join the questionnaire, all right? So the first question, right, is how did you feel about the market in 2022? Right, were you angry, frustrated, didn't feel anything, full of optimism? Oh, wow. Frustration, lots of frustration. Lots and lots of frustration, okay, good. Okay, loud and clear, lots of frustration. Second question, now we want to know what are your expectations for this year, the year of the rabbit? Are you feeling optimistic? No feeling? Still pessimistic? Optimistic, very good. Wonderful. Very glad to see so many optimistic people out there. Okay, following questions, we want to know, in general, where you plan to invest this year. Locally, in Asia Pacific, or globally, or in China? Ming Han, looks like you're going to be the favorite speaker today. Okay. Next, we want to know, in general, what is your preferred asset class? Equities, mixed asset, bonds, or just keeping your cash in the bank? Okay, we have a lot of equity investors in the audience today. Last but not least, to tie it back to today's theme, is ESG important when you make your investment decisions? Wow, wonderful, that's so great. Okay, because we'll be covering that in the second session today. Right, so now with this good insight, we can progress to our main event for this morning. So we have 3 esteemed fund management experts presenting today. Each presenter will have about 10 minutes so that we can leave more room for the panel forum and your questions, right? So ladies and gentlemen, our first market presentation is on the Malaysian market, and this will be delivered by Ms. Doreen Choo, our Head of Investments at Eastspring Investment Berhad. She brings with her more than 20 years of industry experience, and she joined Eastspring from CIMB Principal Asset Management, where she held fund management roles from 2005 to 2018. Prior to that, Doreen worked at PricewaterhouseCoopers, providing valuation and strategy advisory services with particular focus on equity valuation across various industries. Doreen has a Chartered Financial Advisor Analyst charter holder since 2002 and holds a first-class Bachelor of Arts degree from the University of Malaya, majoring in economics. Over to you, Doreen.
Thank you, Judy. Very good morning to all of you. I'm happy to see you out here today. Today I'll be talking about the Malaysian market outlook. And as you know, I know all of you are frustrated, but yet pretty optimistic for this year. So what's really in store for investors this year? Are we hopping into a better year? And is it really a year of the rabbit, bull, or bear? Now, I've just been given 10 minutes, right? So in this short time, my key message to you is that we are expecting a better year for 2023 compared to 2022 because we believe that there is more room for a brighter outlook for Malaysia this year. So we are cautiously optimistic, I should say. What does that mean, right? It means that we are constructive, but yet we are keeping our seat belts on and our ears to the ground. Now, our view is basically based on 4 points, which is a summary of the deck today, actually. So if you just turn your attention to the 4 points here, the first one has to do with growth. So Malaysia will continue to grow this year at about 4 to 5%, right? So we do not expect to see a recession in Malaysia this year. And furthermore, the whole China reopening theme is starting to play out, and we believe that it has not fully been factored into most forecasts yet. So that's on growth, right? Now, the second point is on inflation as well as interest rates. We believe that both are actually close to peaking, basically, right? Headline inflation, at least, seems to be cooling off. And interest rates seem to be nearing the end of the hiking cycle, with perhaps 1 or 2 more hikes to go by Bank Negara, right? Now, the more interesting bit is, of course, politics, right? We all lived through last year when we had GE15. So this year, it seems that the political risk has actually come off a bit, right? And investors are open to giving the government a chance to see what they can show us, right? Now, and finally, valuation. So it appears that the market is cheap this year after the correction last year, and we are looking at corporate earnings growth of maybe high teens this year. Now, this is a summary, diving into each of these points. So very quickly, the GDP for last year was pretty strong. It came in at 8.7% full year, right? First quarter was 5, then it grew by 8.9, peaked at 14.2 and down to 7, but full year it was 8.7. So coming from such a high base, we expect the economy to still show a 4% to 5% growth for this year. Now, what is this strong growth actually based on? It's primarily based on private consumption. So it looks like we are all still spending despite the high prices, right? So private consumption held up pretty well, grew by 7.4% in the fourth quarter. If you take it for the full year, it actually came in at above 11%, which is higher than what Bank Negara actually forecast for last year, which was 9, right? Now, why is private consumption strong? Primarily because the labor market has recovered. If you look at the unemployment rate, it peaked at 5.3 sometime in 2020, and it's actually come off to 3.6%, and it has held at 3.6% for the past 4 months, right? And in terms of nominal wages and real wages, they continue to grow. And in terms of savings, although it's actually come off, the excess savings has actually come off, it is still high. And surprisingly, if you look at the consumer sentiment index, where we are now seems to be actually even higher than where we were before COVID. And just a quick snapshot of the jobs, because we're saying that jobs growth is still strong. So where exactly is this jobs growth being created? It's being created in the orange bar, which reflects the jobs in the services segment of the economy. Now, coming to this interesting theme about the China reopening story, I'm sure all of us are in this race for tourism dollars, right? But clearly the transmission to Malaysia is not just via tourism, it's via trade, commodities, etc., right? But I'm merely looking at tourism on this slide. So if you look at the China reopening story, how important is China to Malaysia's tourism sector? So before COVID, you will see that we had about 26 million foreign tourist arrivals, right? The chart on the left, right? 26, right? And China accounted for about 3 million, so that works out to be about 12% in terms of tourist arrivals. And in terms of receipts, if you look at the table on the right, China contributed about 15 billion versus the total 86. So that's even higher. That's an 18% contribution to tourism receipts. So clearly, China is not insignificant to Malaysia. in terms of tourism, the tourism sector. Now, MATA has actually forecast that Malaysia will receive about 1.2 million tourists from China this year, with about, I think, 3+ billion receipts, right? But clearly, Malaysia needs to get our act in order. If we were to capitalize on this trend, we will need enough labor to ramp up capacity and also to ensure that certain minimum standards are met. Now, it's not all a bed of roses. There is some sign of a slowdown in the manufacturing space. So the left chart basically looks at weakness in the PMI. As long as it goes below 50, it shows contraction. So that has been the way below 50 since the second half of last year. And the main driver of that slowness is actually in global semicon sales, which is shown by the chart on the right. So all in, right, we are still expecting the economy to grow by about 4-5%. Now, so that's on growth. On inflation, as I mentioned, we expect inflation to be like peaked, in terms of headline. So now it stands at 3.8% if you look at the orange line chart. And clearly going forward, will inflation go up, come down? That is really dependent on the government's subsidy policy. So if there's, in particular, the fuel policy. So if, let's say, the RON 95 prices increase, then clearly, there's going to be an impact, a follow-on impact on inflation. Now, interest rates, we expect 1 to 2 more times of 25 basis points each. Recall that last year, Bank Negara raised rates by 1%, but Bank Negara paused in January this year, saying that they want to see the lag effects from the increase last year. So, but we're still looking at about 1 to 2 times interest rate hikes to probably maybe 3.25 thereabouts. Yeah. Now, is this the real new dawn for Malaysia? Okay, there are a lot of skeptics out here. Okay, so we know that political stability is a precondition, is a prerequisite for growth, basically to spur economic growth in Malaysia, right? So it's a forced marriage, right? So we'll see whether the cracks start to show up or not. But so far, what we can see in the market is that the political risk premium has actually fallen, and market is willing to give them a chance to show us what they can do. Now, finally, the bit about the market, right? So Malaysia is not very well loved by foreigners. As you can see, foreign shareholdings is still at an all-time low of 20.4%. In January this year, which is close to the decade low. And this is after foreigners have actually bought 4.4 billion of securities, of equities, right, in Bursa last year. On the bond side, okay, so on the bond side, it's the opposite story, right? Equities, there were net inflows, net foreign inflows. On the bond side, it was actually a net sell of close to 10 billion last year. Valuation looks cheap overall, right? So whether we look at it in terms of price to earning ratios or price to book ratios, basically these are technical terms, but in short, it looks cheap. And just to sum it up, hopefully I made the 10 minutes given to me. In short, we are cautiously optimistic, to recap, right? And the key drivers are the political overhang being reduced as reflected in the political risk premium, which has actually fallen. And of course, secondly, to play on the China reopening theme. And we must not forget to keep an eye out on the various key risks. For example, a global recession, especially emanating from the developed world, right? and persistently high inflation and the possible spillover effects from the China reopening, and our beloved government, right, to see if there are any cracks in the government, as well as what kind of policies are they going to come out with. And finally, possible escalation in geopolitical risks. So I will stop here. If you have further questions, do raise them in the discussion panel afterwards. Thank you.
Thank you, Doreen. Next, we have Mr. Ming Han, the Head of Investments at Eastspring Al-Wara Investments. Eastspring Al-Wara is the Islamic investment arm for Eastspring. Prior to joining the company, Ming Han was Associate Director in Amundi Malaysia Sdn Bhd, where he managed regional and domestic equity portfolios for institutional clients. Ming Han has past investment experience in the industry, including Meridian, Huang DBS Investment Management, and Phillip Capital Management, where he also managed both local and regional unit trust funds and discretionary mandates. He has a long, short equity experience from his working stint as a hedge fund manager in Singapore in 2010. He started his career in corporate finance and brings with him more than 15 years of investment industry experience. So may I invite Ming Han to the stage to give his presentation on China.
Good morning, everyone. I saw the survey polls just now that everyone will be very excited to invest in China. Am I right? Because I think this year is the year for the rabbit to hop in China. Okay? And I think most of you are wondering whether we can pull the magic rabbit out of the magic hat. Right? This year, we think the rabbit will definitely come out from the magic hat. Why? Over the course of the last 30 years, we have seen when China underperforms consecutively 2 years in a row, China rebounds the next year, the third year. Okay? There was only one time in history in the last 30 years where it did not perform on the third year. That was back in 2000 to 2003. And the reason being, back then, we had 2000 was the year of the dot-com bubble in the US. 2001 was the year where we had the September 11 attack, and subsequently it actually flowed through into 2002. So that was the only time China didn't perform 3 years in a row. But over the course of history, the third year is the year where China outperforms. And I think this year will be the year which it outperforms. As you can tell, there are certain policy measures and also certain outlooks that we are going to describe here in my summary here, which tells you that why China this year is going to outperform. Okay? This is just a quick summary. I'll go through in detail in the next slide. Firstly, China's reopening, no turning back. You know why? Because China basically said that they are going to reopen as fast as they can, as early as January this year. And on the back of that, they have already removed a lot of the requirements for example, quarantine testing and certain risk areas to be lifted. And this is in the premise that the economy is suffering. As you know, during the period where there was some protests going on, people were locked at home, they couldn't come out, there was a lot of negative sentiment on the ground. The economy was actually deteriorating, and China decided to reopen. Secondly, the number of infections rose post relaxation of restrictions. And I was having a discussion with our colleagues in Shanghai, and she did highlight a number which was mind-blowing to me. 100 million people got infected. How big is the Malaysian population? 33 million. So 100 million of the Chinese citizens in China were infected with COVID, and they decided to reopen. And this is what you call from flattening the curve to becoming rushing to herd immunity. Everyone had it. Okay, so it's better off you reopen rather than you keep your economy shut. And thirdly, Beijing's CDC highlighted that post China's Lunar New Year, there was no second wave. So thank God, China didn't go through a second wave like a lot of other countries which went through a very severe second wave. Okay, and now China's reopening is picking up steam. Okay, you can see here in terms of the overall Baidu pandemic index on the left-hand chart here, in terms of the COVID surge, it's actually declined significantly since December. And in terms of the mobility index on the right-hand chart there, you can see that mobility started to surge just after they decided to reopen. And you can tell that overall the economic activity also started to pick up as soon as that happened. Okay, so this is no turning back. China is on full steam ahead, going to a rebound in terms of their global growth. So 2023's growth, the overall consensus is looking at around 5% for this year. Okay, coming off from 3% in 2022. And in the context of where this growth will be driven, you can see that overall the properties sector is actually no longer a drag to the overall economy because the government is putting in certain measures. Secondly, infrastructure spending will continue, but at a modest pace. Exports, in terms of the global export arena, we can see that yes, there's headwinds coming from the US tensions, but it's still going to ease at a moderate pace. And lastly, the most important criteria for China's growth this year will be driven by consumption. And you can see that private consumption would recover as any reopening place around this region. As you can see, every country that reopens, consumption drives the growth of the country. China's overall savings over the course of the period of close to 4 to 5 trillion renminbi is equivalent to 14% of annual consumption for the country. Okay, so there's a huge pent-up demand which is in the system, which is going to flow out into the economy. And earlier when I said that the property sector is no longer a drag, as you can see the charts here, there are charts which the government is providing support to the overall property sector. On the left-hand chart is the pledge supplementary lending. It has actually started to pick up again post the reopening. And you can see that the government is making efforts to make sure that the property sector does not become a burden for the overall economy. On the right-hand chart is overall land sales by the government, provisional government, and you can see that land sales have actually also started to rebound. So in the context of overall property drag to the economy, yes, the property sector earlier on was a huge worry for the government, but this year around, I think they're managing it well through the 3-arrow package, which is credit, bond financing, and equity financing. And when we look at on the monetary front, we can see that PBOC, the central bank, is actually making sure that rates are accommodative. Okay, so inflation in China is not an issue. Okay, the market is looking at maybe around 3% inflation rate for 2023, but you can see that the purchasing producers price index and the consumer price index are actually all still at a very low level. It's not even at 3% level. And hence, the new policy rate in China, if China needs to ease further, meaning increase liquidity into the system, they can do so by cutting rates on the right-hand chart. And when we look at the corporate sector, how the corporates are going to do this year, we've seen corporate earnings downgrades, massive downgrades in 2022. As you can see on the left-hand chart, in second quarter, third quarter, MSCI China A shares had also huge downgrades because of the lockdown. Corporates couldn't generate businesses, and hence earnings were impacted. However, this year, consensus earnings expect a huge surge back to close to 16% in 2023. So this is actually going to follow through in terms of corporate earnings, and we expect corporate earnings to deliver close to a 16% return for this year, and hence stock markets will perform in 2023. This is a snapshot of the valuations in China. So when you can see the valuations in China is dirt cheap, right? So for the few years which had overall headwinds in 2021, 2022, you can see the downgrades in PE and also forward revisions in earnings per share. But when that turns, you can see the blue diamond shape. When that turns, actually the stock market returns are positive. So you can see here over the chart here, that's how I mentioned 2 years of negative downdraft. Next year, you actually have a rebound year. So this is going to happen for 2023. Subsequently, also in terms of the dollar versus the yuan, it's actually going to appreciate, which is going to benefit the economy. For the 4 charts here, it's just a summary of where the China valuations are in terms of the PE valuations. And you can see that it has actually bottomed below the 1 standard deviation or even the 2 standard deviation PE graph. and now has actually rebounded close to a -1 standard deviation. There's still room to grow. And to put into context, from the rally since October till now, China is already up close to 40+%. Okay, they are in a bull market. On the year to date, since December 31st of last year until now, February 18, the market is up close to 7.5% to 8%. Okay, so the bulk of the bull market run happened once they reopened between October to December. And hence, I think this year we still have more room for upside. As you can tell, in the years where China really outperforms, they really outperform in terms of the returns. And if you're looking at where to invest in Eastspring, we have 2 funds that we want to sell to you. If you have followed us long enough in the industry, like my salesperson who has basically sell the funds. So I'm telling you, there are 2 funds that we own in Eastspring, which is the Dynasty Fund, which has a long track record. And secondly, the China A Fund, which is focusing on China onshore. Okay, so those 2 funds will actually leverage on the strategies that the fund managers will deploy in the marketplace. What we intend to do for this year, we will see China will benefit on two-pronged areas. Firstly, consumption and reopening. And this is a strategy where the government has no way to, they will not slow down that strategy because they need the private consumption to drive growth. Infrastructure spending, property spending will remain modest because, as you know, of the earlier headwinds. But we see that the preferences for offshore, which is H shares, will preside over A shares. And the reason being is H shares are more internet platform driven, consumer discretionary driven stocks, which have earlier on had negative headwinds. As you all remember, in 2021, there was a theme called Common Prosperity. That theme is no longer an issue because the government said that they would not want to have common prosperity now. It's actually hurting the economy. So what happened? They actually decided to go they had less regulated tightening over the sectors. So the H share space is more consumption driven with more prominent features of China internet names in the likes of your Alibabas and Tencents. And in the A share space, why we are also interested in the A shares? The A shares is one sector which is still very low ranked in terms of the weightage in the MSCI weighting. Currently, A shares in the whole emerging market space is close to less than 10%, okay? But they intend to increase it progressively. And in the A share space, why is it very important to know? In A shares, there's a lot of industrial companies. So that's why we say A shares exposure aligned to policy tailwinds. What do we mean by policy tailwinds? The Chinese government intends to modernize their own industries, and hence the major industry that they need to modernize and focus on is the domestic industrial sector, where there are a lot of SMEs and also high-tech manufacturing companies. This is the sectors which are involved in high-tech manufacturing, for example, renewables, energy transition from wind to solar. These are the stocks which we will plan to focus on for the China A share fund. So there are 2 prongs here in Eastspring where we are looking at from domestic consumption place and also in terms of the industrial place. So if you are intending to invest in any of the funds, rest assured, we will definitely be exposed to both sectors. That pretty much sums up my presentation. So do ask us questions during the next panel session. Thank you.
Thank you, Ming Han. Okay, last but not least, we are pleased to have an esteemed colleague from Singapore to give us a global market outlook, Mr. Ooi Boon Peng, Vice Chairman of Eastspring Investments Singapore. Over to you, Boon Peng.
Well, thank you, Judy, and thank you all for coming. It is a privilege for me to be invited here to speak to you. And I'm going to speak about the 3 R's of the rabbit year outlook, right? R is for rabbit. I will take you through the 3 R's. My aim is to complement what my colleagues have talked about. I'd like to give you a sense of actually what is the thinking and what are the fundamentals behind the drivers that caused last year's sell-off, and what does that mean for the investment outlook going forward, right? Now, so the 3 R's that I will be looking at is, I'm going to talk to you about this recession risk, a recession risk that everybody is very concerned about because interest rates globally have gone up and that's led by the Federal Reserve. But how great is this recession risk? I would like to put it in perspective for you. Secondly, my colleague Ming Han had talked to you a lot about the reopening of China, obviously a big theme. I'd like to tell you about what it means for the Asia-Pacific region. And I think investment is not a straightforward game. I will talk to you about the reservations and things you and I have to look at and to be concerned about. So then I'll give you a summary of what I think. Now, how great is this recession risk? And it is my conviction that we are likely to get slow growth rather than recession. And I'd like to, tell you what is the difference. Why slow growth and not an outright recession? Secondly, I'd like to also talk about the central bank tightening, which Doreen spoke about. Give you more context, actually, what it all means, right? And I also like to talk to you about the fundamental strength of households, not just, as Doreen pointed out, in Malaysia, but actually globally. And that is the heart of consumer spending globally. Okay, let us look the last point first. The last point is that the households globally generally is in a good situation, right? Now this chart on the left-hand side shows you the unemployment rate. The unemployment rate is low everywhere. It's 3.6% in Malaysia. It is 3.4% in the United States. Corresponding to this low unemployment rate is the wage growth. If you look on the right-hand chart, the wage growth in the US is 6%. Last year, Malaysia had a minimum wage increase. You had over 5% growth, right? And even if you look into other developed economies, be it Europe and all that, it is the same. You have a high unemployment, low unemployment, very low, and high wage growth. That basis of which, generally, in the face of high interest rates, gives you a very strong underpinning for your economy. And that's why the recession risk is not great. Never zero, but I think we will get, even in the US, slow growth, but not a recession, which means generally it gives us a better landscape for this year. Now let me move on to this thing that had frustrated all of us last year. And that was the central bank tightening by the Federal Reserve. If you recall, the Federal Reserve has this thing called a policy rate. It's called a Fed funds rate. It was 0.25%. Today, they have raised it in over a year to 4.75%. Okay? And this is not a bad thing. It's frustrating for you, it's frustrating for me as interest rates gone up, because our bond funds went down and so did our equity funds. But this is the basis why they are doing it. It's like a parent giving medicine to the child. Because inflation has to be arrested so that we can keep inflation expectations down so that growth in the long term is sustainable. So you better take your vaccination now, my child, so that in the long term you'll be healthier. So I put this Federal Chairman Jay Powell's text here to give you a sense of what this means. And I'm going to read it. It says, the overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefits all. This is relevant to the US, it's relevant for Europe, it's relevant for Malaysia, right? So this is the context. The frustration that you faced last year gives you a better stability and foundation, and I'll talk more about that. Okay, so what has happened? The second point that gives this landscape better is the fact that the Federal Reserve has done most of its tightening already. just as Bank Negara Malaysia has done it. So on the right-hand side, you see the Fed funds target now. The Fed is quite transparent. They tell you, I want to bring it to 5.25%. They're now at 4.75. Much of it is done, okay? And because of the tightening of interest rates, your inflation has come down. You see the red line on the left-hand chart, we hit over 9%, we are now at 6.4. It will come down to about 3 to 4% by the end of this year. So the Fed tightening is already priced into the market, right? Now, same in Malaysia. This one, Doreen has already shown you. The Malaysian situation is we have tightened, interest rates have gone up, inflation seems to be peaking, okay? I just want to bring your attention to the right side, and you see the 3-year Malaysian government securities at 3.4%. You can see the interest rates now are higher for all your bond funds. Okay, you just keep that in mind. Now, China reopening. The China reopening is a positive on two fronts. Majorly, it will be tourism, as Ming Han has said. Secondly, it is increased trade. And it has definitely big impact on Hong Kong, for obvious reasons, Thailand, Singapore, and also Malaysia. Okay? And I think this part is, the probability of having it a big surge is quite probable because you look at the Lunar New Year holidays, these people with their accumulated savings and the accumulated need for consumption has actually pushed up the tourism domestically in China, and it will have an impact into the end of this year because as airports operations gets normalized, these things will come flowing through. I mean the tourists, that is. So on the left-hand side, these countries that you see here, with interest rates behind tightening already in the economy, and with this tourism impact, most of the Asia-Pacific economies are having slower growth this year than last year. For example, like Malaysia, 4 to 5 instead of 8.7, right? And Singapore, 2%, maybe we had 3% last year. But it's not a recessionary economy here. There is still growth, and therefore I think this provides a stability into 2024 where growth should get even stronger, right? Now, so let me tell you this here. This one, my colleagues have shown you. This is obvious. The price-to-book ratios for China is at a discount. Number two, the price-to-book and price-to-earnings ratio is also attractive for Asia ex-Japan. In an environment where growth will get stronger and interest rates is behind us, right? Essentially what you are, as an investor, with new money going in, you're dealing with two things. You're dealing with higher interest rates and good valuation of equities, which means your dividend earnings yield is better. Okay? Even if you have challenges down the road, the unexpected happens, the very basic of investing is you buy it when the valuation is attractive and interest rates are high because that is the return you're getting, your base return. Although even as you may meet certain difficulties down the road, right? Okay, these are the reservations and concerns I want to talk about because investing is not a straightforward game. You know, I know, right? Now, central banks, although much of the tightening is behind us, is watching inflation. And inflation has to go down, though it is my expectation, though I agree, Doreen, it has peaked, they are watching it. So they are not going to suddenly cut rates to allow you the stock market to rally. They are going to watch it. But I think that's a good thing. Better to have a watchful central bank than an easy central bank. Okay? You may not get near-term capital gains from your stocks, but you have long-term stability for your returns. Secondly, now I know this may sound a bit different from what Ming Han said about common prosperity. The very basic of China under Xi Jinping and even China under the communist government is social stability. If you recall the first term of Xi Jinping's, the main thing they had was anti-corruption in order to produce a society that is more stable. The next phase was this common prosperity. Although you can argue that it was not well implemented, greater equality is important for the stability of the China society. What I will agree with Ming Han is that in the next year or so, is that after the Congress, they need to ensure that economic growth now comes in, right? But behind their minds is the need for social stability, even as they balance enough economic growth, which is also needed for social stability. So it's a balancing game that this China government has to do, okay? So you have to watch the policies down the road. You may get these issues coming up. The other two is long-term. There's no near-term solution. It's the Russian-Ukraine war and US-China tensions. You get the balloon episode again or whatever. And this is something you have to watch for. But overall, unless something erupts, these are episodes which will be opportunities. Okay? So my conclusion here is that we should get no recession, we should get stronger growth, and again, I said inflation has peaked, the central bank's tightening is largely behind us. You are now going into a situation that you have stock valuations that are attractive and interest rates that are high, and these provide you with the very good basis, even though you encounter the unexpected. Your losses will be contained by the fact that you are coming in at this sort of valuation for the bond and equity markets, right? And therefore, I think you must ensure that all your investing is done in a, not putting everything together, but face it out, think through the events. If it comes, it's an opportunity, then invest more. But it should be in the kind of phased approach. So with that, thank you very much for listening to me.
Thank you, Boon Peng. If you would take a seat as we get the stage ready for the next session. Okay, while we're waiting for the panel setup on stage, I'd like to just introduce our moderator for today. Some of you may recognize her as a radio presenter from our one and only business station. We are delighted to have Ms. Wong Shou Ning here this morning to draw out some more insights from our fund managers. A moment. Thank you, Shou Ning. Okay, then may I invite Doreen, Ming Han, and Boon Peng on stage? Yeah.
Anyway, who wants to be closest to me? In the line of fire.
Yes.
Okay.
Oh, you're here, huh?
Yes, I'm on the left. Okay, ladies and gentlemen, we have heard from Doreen on her outlook for Malaysian market, Ming Han on opportunities from China, its reopening, and finally Boon Peng, who guides that, of course, with slower growth, there will still always be investment opportunities, and it's important to stay this course. Now, at this time, I'd like to remind everybody that we are taking questions from the audience. It would help if you state who the question is for. You can do so on Slido. The QR code was shown on the screen not too long ago. But we do have some house rules, one of which is the fund managers can't comment on specific stocks. That's because of compliance, so you're not going to get any tips today, unfortunately. But you will get some big pictures in terms of where to park your money. So I think I'll start by asking the first question for Doreen. And it's this common theme that all three of you all have talked about, and that is China's reopening. I think we're all very excited about that. It was literally 180 degrees change, and suddenly restrictions all removed, literally overnight. Now, how does Malaysia benefit? What are the proxies to this? What are the sectors which we should consider? I mean, tourism is an obvious one, but are there less obvious ones?
I guess in terms of sectors that will benefit, it's the consumer sector generally, right? As you mentioned, aviation, F&B, hotels, maybe even healthcare, medical tourism, things like that. So generally, it's mainly consumption. Yeah.
Okay. Now, I'm going to put you in a bit of a spot, Ming Han. Your GDP forecast, I can see your eyes open large. It's 5%, right? But when I had a look at Bloomberg, consensus is pointing to 5.2%. Are you just being conservative? Could China's GDP surprise on the upside, and what would drive that?
I think we are rightly better off being conservative and then allow the central bank or the government to surprise us on the upside. And I think we are heading into a situation where next month on March the 5th, for a week or so, China will be having their 2 sessions meeting. And this is where the government will actually come out with their major policies for the next few years in terms of growth outlook. And I think the government is actually projecting between 5.5 to 6% GDP growth. So hence, I think on the street, yes, it might be slightly lower than the government's projected forecast, but I think there's a surprise to be made if they really achieve that the target set by the government.
Okay, and Boon Peng, I want to get your views on China's reopening as well. I think the economists' strategy is all super positive on this, right? But even you highlight that policies going forward might be slightly less market-friendly. And President Xi Jinping staunchly maintains his stance on self-reliance recently, especially on technology, and we are going to continue this pursuit of an eventual goal of circular economy. I suppose, yes, it's been pushed back a little bit, but that thesis still remains very strong. Do you think then this is to the detriment of ASEAN economies, especially like Malaysia, right, where we are so dependent on trade?
I think for the China economy, the policies generally have to be balanced out, right? So, number one, the external sector also is important because of the exports, the need for commodities by China themselves, the need for energy. So that linkage has to also continue. Secondly, now, this thing about China and self-reliance, there is also a need basically to, if we have an increasingly bifurcated world between the US and China, China's trade links have also to be increasingly with the rest of the world. Right? Either for energy security, either for commodities imports, or even for the expansion of their own companies. So I have a China that wants to create its own ecosystem, and that is the basis, if you don't forget this whole Belt and Road thing that took place, maybe that is a bit forgotten through the COVID years, but that was something which they had. And I think these links has to continue into Southeast Asia, between Southeast Asia and China. So I think it has to be maintained. I just would like to add one more thing, that no matter how tough the tensions between US and China is, unless it really aggravates, and there's a lot of security issues, there remains considerable trade links between these two big countries. And that linkage is itself some form of containment from an escalation of US-China tensions.
Okay. There's been a question from the audience related to this, and it's directed at Ming Han. So we're talking about this tension between the US and China. Of course, it poses some risk. So somebody would like to know, what are the key areas we should notice? How to position amidst this current environment?
Okay, so this tension which is ongoing, I think we have seen this happening in the history, right? So if you go back into the 60s where you had the Cold War between US and Russia, and back then people were sending people to the moon, right? To be the first one to send to the space. So now in this environment where we have US-China tensions, is more of advancement in terms of technological advancements. So I think here the tensions will be ongoing, but how to position? I think you have to keep your eyes and ears glued to what's happening on the ground. And secondly, the tensions will not fade. It's going to continue. And this is what I will term it as constructive competition. Competition between two countries. Both wants to attract the talent, the resources, and the technological advances. So I think China is really grown so big in the scheme of things, and they are trade partners with the US. So they entered the World Trade Organization back in the early 2000s, and then the difference between now and back then, you need a Cold War between Russia and back then was the Soviet Union versus the US. There was no trade linkages. Now, in this time around, we have US and China still having trade linkages, so they cannot cut each other off so easily. So I have no doubt, yes, the trade tensions will continue, but I think there will be some benefits which will come out from it.
Okay, but I want to follow up with that, right? Because if you look at the Chinese market, it's really rallied since October lows. So Nasdaq Golden Dragon up 72%, MSCI China up 43%, CSI 300 20%, and Hang Seng Index also up 38%. If I look at these numbers, would it mean that there's still legs to this rally? Is there still more upside?
Definitely, there's still more legs for this upside because, as you know, the first rally is usually the one which they rally the fastest due to, the stock market was really bombed out. Last year, you had even a situation where people were saying that whether China is still investable or not. Okay, and everyone was so pessimistic, but obviously the first rally has already gone. Okay, if you have missed it, you've missed it. But the second leg up would be driven by the policy measures of the government. The government needs to keep the country going. Okay, and as my colleague Boon Peng mentioned that, yes, they need to maintain politically stability in terms of society. At the same time, we need to grow the country in terms of their industries. So all these corporates which are supporting the agenda of the country would definitely benefit from policy measures. And hence, I would still say that China is still investable, but there'll be more upside going forward, assuming we can actually leverage on the policies of the government.
Okay, now we've got some questions on Malaysia. We haven't forgotten you, Doreen.
It's okay.
And this is a question I also am puzzled by, because we saw the headline GDP, right? 8.7% in 2022. Looks amazing. But yet that positive figure is not reflected in our stock market. And this is a question from one of you all here, which is very valid. Why is there a disconnect between economic growth and the performance of Bursa Malaysia or even the FBM KLCI?
Okay, I think we need to look at the underlying corporate earnings of Bursa. Last year was clearly not very interesting because the corporate earnings was slightly negative to flat, I believe. This year, we are looking at no more prosperity tax, for example, so the drag on certain sectors should not be there anymore. Generally, we're looking at a high single-digit kind of corporate earnings for this year, and with that, we hope that that will be a strong support for the market for this year. So it all boils down to corporate earnings. Yeah.
Okay, what about your expectations? Question here too about Budget 2023, which will be retabled next Friday. What are your expectations? Do you think there will be any market-friendly policies for a change? Because the last few years, budget has been almost not very exciting when it comes to
non-event, right?
Non-event for markets, literally.
Okay, so I don't have many insights, but if I were to read our Prime Minister's Madani, which is actually the script, what you call the script, which is the policy framework for a better Malaysia, for a just society in Malaysia, I think the tilt is clearly towards social, more social type of agenda, something a bit more equitable and inclusive. Those are some of the themes. So I think drawing from that policy framework, the sense is that there'll be some kind of adjustment to the tax structure, for example, some sort of reform, where the T20, the top 20, will probably bear a bigger part of the tax burden to actually subsidize the B40, for example. I think they call this risk sharing and tax parity, or something like that, some of the terms used. So going by that, I think the intention is to probably even relook at some of the wealth taxes, probably, right? Maybe. Of course, I've not heard anything. It's just, what...
But no GST, right, so far? That's been indicated.
Yeah, I think the indication is no GST because we know that the current government was very strongly opposing that earlier on, right? So generally, that's the kind of trend or tilt we can expect.
Okay, so far positive on Malaysia, positive on China. But Boon Peng, is the biggest risk to all this at the end of the day the Federal Reserve, and how much more of a hawk they can be? Because I'm also undecided when it comes to the data points. It's confusing, right? You've got CPI high, you've got job numbers, job creation very strong, and even until recently, that terminal rate at one point was supposed to be 4.9%. Now the street is expecting 5.2%. Do you think there's the possibility that the Fed might over-tighten, just like they were a little bit too slow to react to what they call transitory inflation, which actually wasn't transitory at all?
I think this is the risk for the risk of more tightening, okay, is there, okay, and we have to be watchful for that. But that is, in my opinion, 5.25 to 5.5 is where I think we should be about there, where they need to bring interest rates to. And after that, I think they will basically keep the interest rate there to make sure inflation comes down. All right? Now, the risk of over-tightening and tight policy is there, primarily because the US, the way to bring down inflation essentially is to bring down wage growth. I show you the chart. That was the main way they had to do it. And that is why if this, but right now as they have tightened rates, we have seen layoffs going through.
Especially in the tech sector in the
and
United
we want
States.
to see therefore wages come off, and they have. But if that is stubborn, then they will tighten more than what we currently expect, right? So that is the risk. Now, is there a risk to over-tightening? I think the risk is small because the Federal Reserve, as they tighten, is watching what is called its follow-through impact on stock markets, the follow impact through the credit markets, which is your bond market. If that thing has gone too much, okay, I think there will be some moderation in their action, okay? But they are willing this time round to accept even a small negative growth in order to bring inflation down. That is the change in their perspective. Last time is, hey, we try not to get a recession, I just slow down. But here is, this inflation is a problem. We are going to make it a bigger priority than it was before.
Okay, so a related question from the audience is then, how do you invest in this kind of environment? I mean, he asked more in terms of like, do you go for value or growth? I mean, how do you approach it?
I think generally speaking, in an environment like this, where interest rates are rising, okay, and if it continues to stay high, and if in such a situation, generally your value stocks would do better, and it has.
Yes.
Okay, and that will continue, okay? When interest rates come to a point where it begins to taper off, okay? And then you have to watch. Then your growth stocks, because your interest rates stop rising, in fact, it begins to fall, then these growth stocks, you must remember, you price them off very forward earnings, not much earnings here, so their cash flow is all up in front. And as this interest rate fall, then the valuation of these things get better.
Yeah.
And in a falling interest rate environment, as a general rule, your growth stocks will do well. But so long as in this phase where the Fed is still cautious and wants to hike rates, your value stocks continue to do well. And it has been doing well in the last 1 year plus.
Yeah, we have seen technology stocks come under pressure, right? Doreen, which then begs the question, this one, is it time to invest in small caps in this kind of environment?
Okay, if you look at the market performance, for example, the KLCI, I think in just looking at the short, short period from year to date, I think the KLCI is down about, 1.2% thereabouts.
Yeah, we're one of the worst performing markets in Asia.
In the region, right?
Again.
Yeah. Correct, yeah. But if you look at small caps, it actually rallied 8% in January alone. So looking at small caps versus large caps, I think generally we see more momentum as well as support in the small cap segment of the market. Of course, there are corresponding risks as well. We need to be very clear about the small caps that we pick. We need to ensure that the cash flows are steady and, in this challenging environment of high interest rates, the financing costs will be high, for example, so we need to be, sure that the company is stable, yeah? So small caps, yes, but be very careful about the selection.
Okay. Ming Han, question on China. One of the audience wants to know whether the real estate sector still has residual headwinds. So yes, you've got the 3 arrows policy, but some would say that this is a crisis of confidence, and that's the hardest part. Is that going to be resolved anytime soon? Is it a sector that you're keeping an eye on? I mean, everyone was very nervous about Evergrande last year and the potential collapse of that.
Yeah, you're right. I think the Chinese property sector has grown to a size which the government believes it's too large to fail, and hence I think this situation here where corporates coming out with a huge balance sheets in terms of their gearing needs to be addressed. And hence, when the government introduced the 3 red lines to address their balance sheet in terms of leverage, it caused certain dislocations in terms of companies unable to borrow more money to fund their growth. Going forward, I think the government is making sure that they manage both sides well. Firstly, do not be too restrictive in terms of the allocation of capital to these corporates, and ensuring that these companies do not go down under, because ultimately it will cause social instability in terms of unemployment or companies which are going bankrupt. So that is why I think that we will have to continue to monitor the property sector, and in an environment where currently interest rates in the world is rising, China is on the opposite trend. So they are still continuing to ease, and hence I think the property sector would actually still have some tailwinds where they can actually still benefit from it.
Okay, what about for Malaysia? Okay, so we know China is reopening. Would it be worth us looking, and this is a question from our audience, to look at commodity plays? So like, let's say palm oil, steel makers here. Would we benefit, Doreen?
I think generally, yes, but I think each of those sectors has their own challenges. For example, palm oil, right, plantations. I mean, it's been plagued by a shortage of workers. We all know that. And even if, for example, CPO rebounds to a higher level, for example, will the companies be able to actually capitalize on that? So that is the main question. So as I said before, that some of these trends are actually positive for Malaysia, but we really need to get our act together to ensure that we are able to leverage off this kind of trends. So, so we need to be prepared. Yeah.
Okay, we've got a question on timing, because someone asked, is it better to invest in the first half of the year, second half of the year? Does Eastspring use technical analysis to time this? Boon Peng, your answer. I can almost imagine your answer already. You're a fundamental fund manager, right?
By way of background, I'm actually a fixed income
Okay.
person because I came from a central bank.
Okay, so,
So I'm not this,
steady ship,
Yeah, I'm
steady
not
the
a
ship.
macho kind of equity fund manager.
All right, maybe I'll pose that to Ming Han then. But steady Eddie is the way to go.
Yeah.
So, but you know, what do you tell investors who say, I want to time?
I think timing is something which you can do broadly, but it's very hard to do specifically. It's really tough. Technical analysis, I think, was very effective in the FX market maybe 10, 20 years ago.
But markets are
Yeah.
so volatile today, right?
So today, the sentiment, you see, technical analysis generally works if there is a certain sentiment, certain trends, and where market positioning is overdone, and then there's a certain change in the price momentum. These are things that you can basically take advantage of in technical analysis. So you have momentums, and you look at the momentum is kind of waning, and then these are your opportunities. I think the technical analysis effectiveness in today's market, where there's a lot of algo trading, there is a lot of market making is done, by systems.
Yeah, computers.
And as opposed to last time, it has reduced its effectiveness. Okay, I think what you can do more broadly is basically look at what the market is pricing, right? If the market has priced in too much expectation of, let's say, a strong growth or inflation coming down, if they're priced in too much of that, I think, and then you look at, you can actually get data from Bloomberg and all that as to how market position. I think those kind of timing approaches can be used.
But it's not for everybody, right?
It's not for everybody, and as a technical analysis, in my personal view, you must choose your indicators, directional moving indicator or support trend lines or whatever, and you have to be at it so
And
that
very
you can
disciplined.
feel exactly whether this approach is working or not.
And also discipline, I think that's
Yeah,
one thing.
and if you are a trader in the market, to cut the losses, or else it psychologically weighs on you.
All right, so it's not for everybody, but the general advice, dollar cost averaging is probably the best, or at least go for the longer term if that's not your cup of tea, if you don't want to monitor markets on a day-to-day.
I would say so, because I think for many of us, we're not trading for a living. We are investing for our income and for well-being.
Yeah. Ming Han, one question for you, and that is, what is your investment strategy for China A shares and also the Dynasty Fund? Because, as we know, the poll shows most people are interested about China.
Yeah, so during my presentation, I highlighted the two-pronged strategies that we have for China, right? Firstly, to cover the consumption catalysts for the country. And you can tell that, consumption is a big area which the government is going to focus on post the reopening. And hence, consumption plays, which I highlighted earlier on, is mostly driven by consumers' discretionary names, internet platform names, which early on had the blunt of common prosperity, the tightening cycle which the regulators really clamped down on them. But this environment is starting to change because we can hear the news on Ant Financial, government giving them approval to maybe even come back to the market. Previously it was shelved. I think there are a lot of developments in that space which is actually turning positive. And meanwhile, on the A share front, that is the sector which drives the A-share market is mainly the industrial sector. Industrial sector on the A-share market in the CSI 300 is a very huge component, more than 25% of that space. And that sector, we think over the long term will fulfill the agenda of the government because the government wants to focus on high-tech manufacturing, renewables, energy transition. The three sectors which we think would benefit on the longer term because they will have policy support coming from the government.
Okay, and maybe a final word on ESG investing, which of course stands for environmental, social, and governance. Boon Peng, can we afford to ignore this team?
I think this is something you cannot ignore, and I really, this is I'm saying this from my heart because I think many of us have children, and even if you don't, if you live long enough and you see the deterioration in your environment, no matter how much financial security you have, you're not going to have the quality of life.
Yeah,
right?
climate change is real.
Yeah, so that part is very important, and in limited ways, I'm also trying to cut down my consumption. It actually requires quite a bit of lifestyle change for all of us, generally, in terms of how much you buy and all that, what you wear, what you eat. It requires, and I think my children are more aware of these things and has been educating me as well.
So not only in a way of life, but also I think fund managers increasingly
Correct.
see that, right?
Right. So in Eastspring, it is a value. It's like a personal value. I believe in ESG. And the value, therefore, has to translate into our ESG practices as a fund manager. Now, the very basic of ESG is actually, ESG is a very broad term, but the most basic thing and the most worrying thing is your environment right now, right? So there'll be governance is something we always do as a fund manager. This management cannot be trusted. Governance bad, don't buy.
Sell.
It's there. We've been doing it. This environmental thing, the very basics of what they try to manage is what is called a 2-degree world. I cannot get world by 2050, 2060. I don't want this, or end of this century, I don't want the world temperature to rise by 2% to get the kind of quality of life that we want. And the very basics of that 2% is actually carbon emissions. And the very basic, and as a first thing that Eastspring has done is, number one, to lower the carbon emission intensity of the portfolio of companies we hold. Get all the, your carbon intensity, and make sure that what we hold is coming down in value.
It's measurable, right?
It is very measurable. Right? You get the carbon intensity of that company, you hold 10 companies, you weight it according to what you buy. That's one. Number two is to reduce the holdings of coal generation plants, generally, right? And also be watchful that revenue from that part should not be 30%, or are they actually transforming themselves? So that's the other part. And the third part is to look, you see, the basics of ESG, you go back to what is called United Nations 17 Sustainability Goals, and you see how these goals are being met or not by the companies you want to invest in, and whether these things are affecting their bottom line. Because if they are not doing a good job, they are in future trouble, because regulation will be more ESG, things may change, they may be disrupted, so these things have and is embedded therefore into our investment process. So those 3 points.
All right, thank you very much. And on that note, we've unfortunately run out of time. But ladies and gentlemen, if you have any questions that we may not have answered this morning, please feel free to approach the Eastspring booth at the back of the hall. Of course, you can also speak to your Eastspring representative if you would like to know more. With that, I want to thank our panel, Doreen Choo, Head of Investments, Eastspring Investments, Ming Han, Head of Investments at Eastspring Al-Wara Investments, and of course, Ooi Boon Peng, Vice Chairman of Eastspring Investments Singapore. Back to you, Judy.
Thank you, Shou Ning, Boon Peng, Ming Han, and Doreen. Ladies and gentlemen, we'll have a 10-minute break. We hope you found the session riveting. Do come back in 10 minutes' time, about 11:05. We have our second panel session where we will cover our speakers from the social enterprises. See you back.